Thank you so much for the warm welcoming, Nir, and thanks for the invitation to the seminar. I'm excited to be here. And yeah, as I guess Kite said previously, feel free to interrupt me at any point in the talk should you have any question or like the Q&A function. So today's topic will be on my joint work with Semak and Tim on the economics of liquidity provision in AMMs. So currently there's about $5 billion that are providing liquidity on these decentralized markets. And these liquidity providers who give capital to AMMs are clearly subject to some risk. And the question is, how much is that risk? So in 2022, along with our co-author Anthony, we introduced Lever to precisely account for the arbitrage losses in AMMs. And so since then, there has been lots of discussion on the losses of liquidity providers, and Lever has become the center of focus for a big part of it. And lots of research effort has been poured into figuring out ways to mitigate Lever. But a question that arises is basically what happens with fees. So what about fees? And namely, this means that Lever was derived as the profits obtained by arbitrageurs under the assumption that arbitrageurs can snipe the prices in the pool without having to pay fees. Now, obviously, pools do have fees, and so what we would like to actually do is refine our understanding given the presence of fees. So I will be splitting this talk into two parts. First of all, I will explain to you what the cost is of providing liquidity at an AMM, and that's going to be Lever, and under which characteristics it is driven. I'll also show that it actually empirically can capture very easily realistic data from actual decentralized exchanges. And then what I will show you is the exciting follow-up work that we have on what happens to the arbitrage profits when we also introduce trading fees and discrete block times. So one of the main takeaways of this talk is going to be that the losses to liquidity providers that used to be Lever will now be, well, what a surprise, Lever again, but multiplied by the probability of trade, which we will see later in the talk. So as a result of this, what we show is that faster block times lead to the arbitrage profits going down. But more than that, our work shows that Lever is still very meaningful in that it is precisely the informational cost that is split into one component, which are the profits to the ARBs, and the rest of it that is returned to the LPs in the form of fees. Now, there has been lots of great literature relating to our work, but in the interest of time, let me just mention three axes that are relevant. First, it's the huge axis of great work on options pricing and market microstructure literature that our adverse selection work is based on, basically, many insights of this literature. The one on prediction markets is relevant to AMMs, of course. And finally, the literature that has sprung up in the latest years that concerns the use of AMMs to actually build these decentralized exchanges. So in the interest of time, let me not mention exactly these works, but you can see a good description of those in the slide here. So first, let us go into some background, and then I will review the basic Lever model, and finally show you what happens when we also introduce trading fees into the model. So the key question with AMMs is basically, how do you perform low-cost price updating in an exchange in some fashion that is automated? And so AMMs, what they basically do is that they organize all of the liquidity providers into pools of joint assets. And the running example in this talk is going to be the one where we have the Ethereum US dollar pair. So a market that is structured as an AMM is such that it will always accept orders to buy or sell at some quoted price. And then the question is basically, how do we actually set that price? One mechanism to do that is what we call constant function market makers, or CFMMs, that, for example, have been used in almost all of the relevant work in centralized exchanges, where basically the key characteristic is that the trades have to be on the level curve of a function. So this means that if you have a function of the pool asset quantities, then along trades, the value of this function must remain constant. And so the most popular such format is, for example, the constant product market maker, where this function f is x times y. So x times y needs to remain constant over all trades. Now, what is clear in this framework is what the liquidity providers actually gain from providing capital in this, and that is the trading fees. So they obtain a cut of the volume that is being traded on this exchange. Now, what is less clear, and we definitely want to understand, is the cost of market making. We've basically known forever, going back to the famous work of Glosson and Milgram, that the price of doing business as a market maker is exactly the so-called adverse selection costs, which basically arise from the market maker trading with better informed parties. And our work is exactly going to focus on characterizing these costs. So let's start with some modeling. Let's say that we have a risky asset, X, for example, Ethereum, as you should imagine the running example in the stock, and a numeraire asset that everything is denominated in, Y. For example, you should imagine USDC. And let's say that we have the market price of the asset, for example, in some infinitely deep centralized exchange, be denoted by PT. Then, let's also say that we have the risk-free rate to be 0. That is completely without any loss of generality, as the Black-Scholes model shows, but we won't focus on that in this talk. We're going to have a probabilistic model for this market price, which is the standard model in quantitative finance, that of the Black-Scholes model. So for those of you who might not be familiar with this model, the 1-minute explanation is that over small time horizons, so basically for a small delta t, the returns of the asset in this period are going to be normally distributed with a mean that's basically driven by a drift mu, and the standard deviation, which is driven by some volatility process, sigma t. So for example, the price is going to look something like the curve that you see on the slide. Now, let's go into some background about CFMMs. As we said, CFMMs are characterized by some function that we call bonding curve, f. So f of x comma y has to be L. And we previously mentioned the example of the constant product market maker that's, for example, implemented in Uniswap v2 that takes the function f to simply be the product. So now you have this function graphed as the reserves that are contained in the two pools of the asset. And let's suppose that you are at some initial state where you see that the pool has x0 Ethereum and y0 US dollars. That corresponds to a particular point in this curve. Now, if anyone who wants to perform a trade with this pool is going to pick some other point on this curve, for example, let's say the point x1, y1, and is then going to move the AMM accordingly. So what does this mean? This means that basically what happens is that they're going to they're going to sell to the pool some risky asset x1 minus x0, the difference between the two states, and they're going to get from the pool the respective difference in the vertical axis. So that is y0 minus y1. So the average price that the trader ends up paying for this trade is going to be the ratio between the difference of these two quantities. Now let's notice what happens as you take these 2 points to be closer to one another. So as you make the trade be basically a marginal trade. Then we can show that what actually happens is that the price that you end up paying is exactly the negative of the slope at a point. And so formally, we say that the spot or marginal price of an AMM is given by the slope of the tangent or the negative of that. So it's the expression that you see right here on this slide. Now let's examine in the model what participants we're going to have in this market that we're building. We consider a stylized model where we're going to have 2 types of traders. First of all, we're going to have arbitrageurs. What these people do is that they continuously monitor the market, and they can either trade on the AMM or they can frictionlessly trade on some infinite depth centralized exchange. Now, the simplifying assumption for this first part of the talk that's focusing on lever and that we will revisit later is that these people, the arbitrageurs, do not pay fees in their trading with the AMM. Therefore, the optimal thing to do for them whenever they see a price deviation of the pool and the centralized exchange is to basically rebalance the pool to this external market price that they see on the exchange, BT. So that's all the function that arbitrageurs are actually going to observe in the AMM. And then we will also have noise traders who actually choose
Can
to
I ask a
trade in the
question?
automate market. Yes, absolutely.
So when you're considering fees, you only think about liquidity pool fees, but what without moving money from blockchain to the centralized exchange and the other way? Like if there is kind of a checkout cost if you want to move liquidity from blockchain to Coinbase or whatever.
Yes, so this would be additional cost that you would like to add to your total cost, let's say, of trading with the AMM, but these are not involved in adverse selection costs that are the ones that we're studying. So the key focus of the lever model is basically these informational costs that are only caused by the fact that your AMM is actually trailing some leading venue of exchange that always has the most up-to-date price. So this is the cost of lever is exactly the adverse selection, and you can then add a bunch of other costs to obtain the cost-benefit analysis of a liquidity provider. That's going to be the fees minus the total cost that they will have. So that's how we'll do it.
I see. Okay, fair.
Yes. So these noise traders, they choose to trade in the AMM, let's say because they like the convenience of execution in that venue. And they do pay fees in the AMM. And we're going to denote these by a cumulative fee stream, fee sub t. So now, let's define, first of all, we're going to use a reparameterization of a CFMM, and in general, move on to more general, what we call smooth AMMs, basically. You can rephrase this f of x comma y interpretation in terms of the price. So you can basically represent a pool as the quantities that it holds at each price level. So instead of now having the 2 points, x comma y, I'll now have these curves, x of b and y of b, along with the current price of the AMM. So this is what we will consider from now on in this work. And this generalizes more generally than CFMMs to what we call smooth AMMs, but we're not going to focus on that on the talk. So we will define a specific self-financing strategy that we call the rebalancing strategy. What this strategy basically does is that it starts with the same assets that the pool contains, and then it rebalances, it changes its composition such that it holds the same risky asset quantity as the pool, but at market prices. So now we're going to have a bunch of market prices. As these update, the pool reserves change. You should also change the contents of the pool, of the rebalancing strategy, respectively. And so this rebalancing strategy is going to have some portfolio value that we will denote by RT. And we will also denote by V of P the value of the reserves that are actually contained in the pool at some price P. So if you do that, then what we define lever is going to be the difference between the value of the rebalancing strategy minus the value of the pool. So intuitively, one of the key takeaways is that if you actually implemented the rebalancing strategy, then you would systematically make more money than the pool. And so what lever quantifies is exactly what the difference is between what this strategy could gain compared to what the AMM actually does gain from trading. So what we characterized with our co-author Anthony in 2022 is that this lever process, if you study it as a stochastic process, it's a non-negative and always non-decreasing process that is basically going to be characterized by the marginal liquidity that is present in your AMM times the quadratic variation of the price process that you have. And so an example is basically in the constant product case, such as the one by Uniswap v2, this quantity is going to take, inside the integral, is going to take a particularly nice form. It's only going to be sigma squared over 8. And so, for example, this means that if you have a daily volatility of, let's say, 5%, then the portfolio loss to the liquidity providers due to adverse selection costs is going to roughly amount to 3 basis points of their portfolio value. So they're basically going to lose an annualized factor of roughly 11% of their portfolio assets. So let's put this methodology into an empirical test. Again, there's two things that you can do with this framework. One of it is that you can study the income stream that you obtain from noise traders, which is phi sub t on the right-hand side of the inequality, minus this lever cost, right? So the right-hand side is basically the fees minus lever. And what the theorem previously tells you is that this reflects exactly the profits of the liquidity providers in the model where arbitrageurs do not pay fees, if you additionally delta hedge the market risk that they obtain. So basically, let's examine what we have here and how we can use that empirically. We're going to have on the left-hand side the return of the delta hedged LP position that does not assume any model. Why does it not assume any model? Because you can simply look at the LP profit and loss directly from the pool that you actually have. And then you can also delta hedge the AMM at some different discrete time horizons. So you can look at what the price was, let's say 5 minutes later, and you can remove that from your current profit and loss. The right-hand side is going to have our model. It's going to use our theory, and it's going to be the fees minus lever. So for the fees, you can directly measure how much trade volume you have on the exchange, and you can multiply that by the fee rate to obtain what this fee income stream is. And as for the constant product market maker, we have the sigma squared over 8 expression. If you use the same day 60-minute realized volatility for your volatility prediction, and you multiply that by the pool value, then you can measure exactly what the lever of the pool at that instant was. So there are two questions that we're interested with these empirical analyses. First of all, is the analytical formula and the model actually accurate in capturing the delta hedged returns of liquidity providers? And secondly, is actually providing liquidity attractive? So basically the cost benefit analysis that's going to be the fees minus lever, is this attractive or is it not? So you can see here some data set. We're going to use the Uniswap v2 Ethereum USDC pool. You see here the realized volatility, the 60-minute realized volatility, extrapolated to a daily rate, exactly as I told you in the previous slide. And the pool value is going to be reflected as something like the curve that you see here. Now, the profit and loss that you can measure directly from data is going to look very jagged, something like that. But now if you additionally use the hedging, then what you can actually see is that you can get roughly almost nearly straight lines. But now let us ignore the actual profit and loss and let's go into specifically how the hedged profit and loss matches lever. So zooming in and looking at these curves, what we can actually see is that the purple curve that uses the lever model. So in all of these curves, the purple curve is the only one that uses a model. All of the other curves use no model, but only empirical data. What you can see is that, for example, if you hedge every 5 minutes, that is the red curve, the red curve is practically indistinguishable from the purple curve. And so if the first model that you write down, the lever model, is actually going this close in practice, then that means that you must have done something correct. So what we saw in the previous section, this first part of the talk, is that basically whatever the ARBs see that the AMM price is different, then what they will do is that they will actually trade on the pool to exploit that. And as we established, under the previous assumptions in this model, you have that lever is exactly the profits obtained from arbitrage. And so what are these key assumptions that we made? First of all, the arbitrageurs can trade continuously with the AMM. Well, the reality is, though, that you cannot trade continuously in a pool, right? But you can only trade when the blocks are actually generated. And secondly, that the arbitrageurs do not pay fees when they actually trade. But of course, AMMs apply fees to everybody and not just to noise traders. So they also do have to pay fees as well. So in reality, what we're expecting is that we're not expecting the arbitrageurs to make this much money, as the lever says, because there's these two frictions. So let's try to relax these assumptions one at a time to make the model more realistic. So first, again, what you see here is the external market price in red, and we're going to depict the AMM pool price in blue. So what is the thing that happens, as we said previously, when arbitrageurs rebalance the price continuously in the pool without paying any fees? Well, you would see that the two curves would be exactly the same. So the blue curve is overlaid on the red curve perfectly. But what if now the arbitrageurs can only arbitrage the market whenever the blocks are actually generated? So what you see here is that you see on the horizontal axis, you see these red axes. Let me draw your attention to these red axes. These are the times that you have blocks. On these times, these are the only times that you can actually trade on the exchange. So what do we actually see? We see that in the AMM bull price, there is now periods of quiescence in the blue curve, where nothing happens. And the only moments where something may happen, a change may occur, are these moments when a block actually does arrive. So these red axes. And what is this change going to be exactly? Well, arbitrageurs are still not paying fees, right? So the change is going to be that the pool is going to be rebalanced by the arbitrageur exactly on the red axis to the external market price at that instant. So you see that at each of these axes, the blue curve changes to match the red curve at that point. Now it's time to also introduce fees being paid at these moments that the arbitrageurs can rebalance the pool. The effect is basically going to be that you're going to have a region on which the arbitrageurs will not trade. This is the gray shaded region. This shaded region moves around because it depends on the current pool price. So this gray shaded region is always a price that is around the current AMM pool price. What this basically tells you is that the arbitrageurs will not always trade because the marginal profit that these arbitrageurs would obtain if they traded within this gray shaded region would actually be negative. And so intuitively, what this says is that there needs to be some good price deviation in order for the arbitrageurs to actually be able to profit after the fees being taken out of them. So what do you see here again? You see these red axes, the red arrivals, right? On these red arrivals, nothing actually happens because the price of the pool at that moment and the external market price are within this band of negative marginal profit for the arbitrager. So the best thing for the arbitrager to do on these red axes is not to trade. And
Okay.
now let me focus your attention. Oh, yes, sir.
So the gray area, it's the liquidity pool fee, and it's also the gas fee, or it's just
So
the
the gray, yes, so that's actually a great question. In this work, we're going to ignore the gas fee. I'm actually working on some follow-up work, and we have some preliminary results with gas fees as well. But the key thing here is that you're going to have a fee that's going to be proportional to the trading volume. So that's going to be your trading fee and not the gas fee. So this only includes the trading fee. And if you only include the trading fee, then this gray shaded region around the AMM pool price, it doesn't actually depend only on the trading fee. It depends on a host of other factors. We're going to see later in the talk which these are, but it's a bit more complicated than just the trading fee. For now, you should just believe me that it's just some region around the market price, around the pool price, and we will later see exactly how that region is captured. Does
um,
it cover it?
yeah. And another question is, okay, I guess like your empirical stuff, you only focus on Ethereum, right?
Empirically, we only examined the Uniswap V2 Ethereum USDC pool at these instance that I showed. Yeah.
Yeah, so I'm just thinking about like what's going to happen if you do this in L2
Yeah.
pool when the blocks are almost nothing.
Mm-hmm.
Or
Yes.
maybe,
So I'm actually in the final moments of the talk, I will tell you why the empirical analysis actually holds with lever as is without any adjustment whatsoever. It will be a very surprising thing, but a very neat and I
okay.
believe very nice thing. Yeah. So yeah, that stay tuned for that in a little bit. So basically, if we now look at these green arrivals, right? Then on these green arrivals, we have that the external market price at this instant is outside of the gray shaded region. So this means that the arbitrager is actually going to go ahead and actually rebalance the pool. Now, what you actually see, though, is that the arbitrator is not going to rebalance the pool all the way until the external market price. You see that the new blue price is not all the way to the red. This actually happens because for the last marginal unit of trade where the marginal profit is exactly zero, that's not going to be at the market price. Because at the market price, your marginal profit as an arbitrator is going to be negative. So the price is always going to be revised, but it's not going to be revised all the way to the external market price. It's going to be revised some portion of the way to the market price. So given what I showed you before, let's see the mathematical model that you'd expect. First of all, we model the block arrival times as a Poisson process with some mean delta t that we'll use. And we also have trading fees that correspond to uniform proportional fees. So a gamma fraction of your trading volume, for example, 30 basis points, the arbitrator is going to pay that in fees. And so now some additional notation before we move on. As we saw before, we have the external market price, that is PT. Now we'll have PT tilde as the implied pull price of the AMM. So that was the blue curve that you saw previously. And we will also examine the mispricing, the relative mispricing between the pool and the external market in what we denote by ZT. That's going to be the log mispricing between the pool and the external market. So the Poisson assumption here, it might draw your attention. It's the standard assumption that's used typically in quantitative finance. And actually, it's the reason that we can have the analytical tractability in our model. You can alternatively simulate deterministic processes that are more suited to proof of stake blockchains, let's say. And these, according to empirical results, seem to be close to our model. But the good thing with Poisson is that you maintain the analytical tractability, which you actually do lose with a deterministic block time. So here we're actually going to focus on the mispricing process for a second. The bottom picture is the picture that I showed you earlier, and this is what's happening to the price. And if we now look at what's happening at the mispricing, what's happening is that actually the arbitrators are going to trade until their marginal revenue that they obtain is exactly the same as the marginal cost. So that is the fee that they obtain. So their marginal profit is zero. So what you actually see on these green instants now, let's focus again on those, is that basically they're going to, so the mispricing at that moment is going to have exceeded the fee. They're going to trade that back into exactly the fee boundary. So that's the effect that you'll see. And now let's formally express that. What does that mean? That means that whenever you see a block that arrives, the arbitrator is actually going to trade if the mispricing at that moment is outside the boundary indicated by the trading fee. And how are they going to trade? They're going to push the mispricing exactly back to that boundary. And reminder, the reason for that is that the marginal revenue is going to be exactly equal to the marginal cost, so that their marginal profit is zero at the moment where they stop rebalancing the pool. On all of these other instances where you don't have any trade, so either no block arrives or a block arrives and the arbitrator doesn't trade, the mispricing is going to be basically evolving like a jump diffusion process, what we call. So it's going to have the form that you see on the slide. And for simplification in this talk, we're going to also assume that the drift that this process has is basically zero, so that we can express results in a simpler way. The paper contains the full results, but let's just focus on these for this talk. One nice thing is that we can actually obtain the stationary distribution of this mispricing process that I showed you before under the Poisson process. And specifically, the unique stationary distribution is given by a density that you see there. So what this shows you is that it's going to have exponentially dropping tails outside of the fee boundary, outside of the fee range minus gamma gamma. And within the fee range, it's going to have a uniform probability of being anywhere in that range. So that's what the stationary distribution of mispricing is going to be in our model. Now, as a corollary, we can also obtain the fraction of blocks that we expect to see containing an arbitrage trade. And that's going to be basically 1 over 1 plus eta. Now, this quantity eta is basically the fee that is divided by a typical return over half of the block time. So under the geometric Brownian motion, this is going to be sigma root half of delta t. So eta, what it's actually doing is quantifying how wide your fee band is relative to how much the prices move in between the blocks. So let's see an example of what this means about the fraction of blocks that you expect to see to contain an arbitrage trade. If you assume a daily volatility of 5% and let's say a 12-second block time, then you can basically see that for 5 basis points, let's say trading fee, you expect roughly half of the blocks to contain an arbitrage trade. This table similarly shows you with 5% daily volatility, what you expect for different combinations of trading fees and block times to see. So now what we're going to do is that we're going to express the cumulative arbitrage profits over some interval that you obtain. Let's denote these by arb sub t. And what we're actually going to focus on right now is going to be the instantaneous rate that you observe these arbitrage profits. So that's going to be basically a time average of the cumulative arbitrage profits that you see. And it's roughly capturing the notion that you saw inside the integral of lever. So that roughly captures the instantaneous rate that you're actually losing due to adverse selection. And so our theorem in this paper is that in the asymptotically fast block regime, so as block times go to zero, and under some not so interesting, I would say, technical assumptions, the arbitrage profits, the rate of arbitrage profits that you get is actually going to be roughly roughly the instantaneous lever that you had before times the probability of trade. So what you can basically see here is that the quantities that are highlighted in orange are basically almost the same for a fee that's going to be small. So if you have both a small fee and a small block time, then these two quantities are exactly, they look similar to one another. Plus some rate of root delta t, that's going to be your approximation factor for this. So comparing what you get on the slide, the rate of arbitrage profits that we now expect is going to be the instantaneous lever times the probability of trade. Oh, I see a question, I believe, from the...
So hi, Jason. It's Michele from Paris. So I'm also working on constant function market makers with Julian Pratt, and I had a look at your paper, and I think it's a great work. So very impressive. So I was going through it, and I have a question on the arbitrage formula. So basically, the clarification I wanted to ask is why there is gamma is the fee, right? Is the fee
Yes.
rate. So in the formula, it both appears e to the fee and e to the minus fee, while in the probability of trade, essentially is 1 divided by gamma times some factor. So I was wondering where these exponentials come from.
Yeah, so this formally has to do basically with the fact that the Poisson process is basically affecting all of these. The actual form of the fees that we're going to have, it's not going to be exactly gamma. It's going to be roughly an approximation of that. That's going to be 1 minus e to the minus gamma. So the reason you need to do this is because there is some symmetry assumption going on here that is basically hiding itself into the suitable technical assumptions that I said before. You need to do some symmetrization trick here for the fees in order to obtain good results. And I'm happy to talk about this after the talk if you're available. But that's the reason why you see here the e to the gamma instead of the gamma as it is.
Great. Thanks a lot.
Yeah, absolutely. And so basically, let's see what we have previously from the slides. Fact A that we have is that the probability of trade scales with the root of the block time. And the fact B is that the rate of arbitrage profit is roughly going to be the rate of lever times the probability of trade. By combining fact A and fact B, we get that the arbitrage profits actually go down with the square root of the block time as well. So one way to reduce arbitrage profits is to basically reduce the block time. And this is great because it benefits the LPs, and presumably the retail traders are indifferent, or it's even better for them because they get cleared faster. So they obtain a faster confirmation. But there may be, of course, other considerations outside of our model that interfere with faster block times, like decentralization, for example. And so if you manage this model, what it says is that if you manage to drop the block time from 12 seconds to 3 seconds, then according to this, the arbitrage profits get reduced by roughly 50%. So that's a quite substantial amount, I believe. So let's do now the analogous thing that we did before, but with fees. And I won't go through the details, but I hope you believe me that when I say that if you look closely, you'll get the following interesting results, that the fees that are taken from the arbitrageurs are essentially whatever remains from lever when you subtract the arbitrage fees. So the fees that are the instantaneous rate of fees that are taken from arbitrageurs, it's roughly going to be lever, or again, some approximate value of lever, times 1 minus P trade. So this means that the sum between the arbitrage profits and the fees, instantaneous rates, is going to be the instantaneous lever that you see. Of course, up to the asymptotic approximation of the fast block regime, always, and small fees. So you can't have this for huge fees or huge block times. And so one innovation basically in this paper that might not be obvious at first sight, but I believe that I have highlighted in this talk, is that the use of Poisson arrivals actually allows you to get very analytically tractable results. And that same technique can actually be applied to other types of fee structures that have been proposed to mitigate lever. And I think that this is a very exciting direction to have. So to recap, what we actually saw is that lever is going to be split between profits earned by arbitrageurs and the fees paid by arbitrageurs to LPs. And the controlling factor in the split, it's going to be this quantity that's the probability with which you actually see a trade. So the rate of the arbitrage profits is going to be the instantaneous lever times the P trade. The rate of the arbitrage fees are going to be the lever times 1 minus P trade. And the sum of those two is going to roughly be lever again. So let me now go into how this relates to actually the empirics that we saw before. And actually, a good question that some of you might have is how is it even possible that the standard level model still characterizes the observed empirics that we saw before? Again, the empirics that we saw before did not include any modeling of the trading fees for arbitrageurs. And yet, as you saw, the hedged returns were virtually identical to the model that we have. So how is this even possible? Now let's do some calculations and see why this is actually possible. So the hedged P&L of an LP, it's if we now account for the trading fees, it's going to be the trading fees that you obtain from these noise traders minus the arbitrage profits that the arbitrageurs obtain. From the theorem in the previous slide and that we've analyzed currently, these arbitrage profits are going to be whatever remains from lever if you reduce the arbitrage fees. So if you rearrange those terms, you actually see that under this approximation, which of course we said already, it doesn't always hold, but it holds if you have an adequately fast block time and an adequately small fee, the LP profit and loss is going to be the total sum of all fees that you see on chain minus the original lever quantity. So what this tells you is basically that lever still has the central role in capturing the informational cost to liquidity providers from adverse selection, from having a leading price venue not be your own AMM that you're providing liquidity on. I want to emphasize that because I think that's a really nice point, that the original lever model that you use, the first thing you write down, turns out to be exactly the one that remains, even if you make the model sufficiently fancier. That's, I think, a nice attribute of the model that we have. And so finally, our work has lots of implications basically for how you should design an AMM. And as we said before, there's been an insane amount of research effort being poured into actually trying to mitigate lever in exchanges. So there's 3 key directions that I want to focus on talking to you here. The first is basically the approach of dynamic fees. So it's this whole idea that perhaps you can adjust the fees that everyone pays based on the market conditions that you somehow see. So for example, the realized volatility that you see, or the price variance that you see, or the realized lever if you've measured it through some other way. And going into the same direction of dynamic fees, maybe you can institute more complex fee rules, such as non-uniformly proportional trading fees, in order to have a similar effect of reducing informational asymmetries. Another axis is that of Oracle AMMs, where the idea is that you could incorporate external market prices into the AMM quoted price. That's also a very interesting direction of study. And finally, there's also the suggested direction of auctions, or otherwise how to monetize the rest of lever also, that basically says that perhaps you can auction the right to arbitrage the AMM, for example, whether that should be from the first trade in every block or some other mechanism, in exchange for compensation provided to LPs. Then market competition conditions are actually going to tell you that what you should obtain as profit from the auction that you can give back to the LPs is going to be exactly the arbitrage profits that were going to be extracted by those privileged to have the right to do that. And so I want to conclude by saying that essentially what we consider lever is basically to be the Black-Scholes formula for AMMs. And so what we did with this follow-up work is that we also introduced the impact of trading fees and block generation. We also saw that you can actually get very neat and close form results in a slightly more complicated but still analytically tractable model through key assumptions that you can make. And with that, I want to conclude the talk, and thank you. Yeah.